All right, we are live. Thank you so much for joining me in today's video. As you can see, I have a new background here and oh, hey, Jim.
Wait, right here.
Good to see
Hey,
you,
good to
man.
see you.
Wow, that's awesome.
In person, live. Wow, this is cool.
Wow,
Good
yeah.
to see you. Wow, how do you sneak into my studio?
I don't know. I guess we're in the same room, I guess.
All right, cool.
Yeah, everyone, thank you so much for joining. Obviously, I'm with Jim Black in person. I haven't done a live stream in person with anyone. Actually, this is the first time I've done
Wow. Thanks for having me on. Appreciate it.
this. Yeah, absolutely. So yeah, we want to talk about two things actually. So the title of the video is talking about rates. And by the way, please leave a comment or leave us a chat if you guys can hear us just fine. But there's basically two big news reports that was announced today and yesterday. Today, the big increase in rates. So average 30-year fixed rates increased to 7.5%, according to the Mortgage News Daily. Just about 1 week ago, we were at around what, 7.1%. So big increase in rates. Great, thank you, Brianna. Big increase in rates over the past week, and right now at 7.5%, the highest rates since approximately mid-November last year. So we'll talk about how that could potentially impact our housing market. If you're a home buyer looking to buy a house, what you can do to make your payment less affordable, or more affordable, I should say. And also, maybe Jimmy can talk about the news announcement that was announced regarding seller concessions as well, very briefly, and we'll talk about that here a little bit too.
Sure, absolutely.
Well, I meant to say.
Oh, all right. So there's two big stories again, like Jason mentioned: interest rate fluctuations, how that affects inventory. The bigger story is just the reaffirmation yesterday from Fannie and Freddie Mac that the concessions paid to an agent do not count towards the related party concession amounts that are allowed in a transaction. What this means is that normally you'd have a 2 to 6% amount of concession that's allowed for anything from closing costs, which are transactional fees, to credits for things like repairs, or to paying items that the buyer may have as a one-time non-recurring closing costs. The biggest fear for real estate professionals was that that cap or margin would have to include their commissions. Well, great news was reinforced again yesterday that that commission is not going to be counted towards that overall cap for margin. Which, yeah. What does that mean, Jason?
Well, maybe we can kind of give an example. It might be helpful too. So what Jim's saying that, a $500,000 purchase, maybe your maximum, that your concessions that the seller can give you as a home buyer is what, 6% of the purchase price?
Yeah, it's anywhere from 2 to 9% technically. It depends on the type of loan program. Right. Yes.
Yeah. So what basically this new announcement was talking about how the maximum allowed that the seller can give you as a concession, and a concession is which the seller, let's just say they give you $10,000. That decreases your out-of-pocket expenses in buying the house by $10,000. That is called a seller concession, but there's some maximum amounts that the seller can give you. So what the challenge is because this proposed settlement from NAR, how will that impact when the seller is not willing to pay the buyer's agent any commissions? So will the buyer's agent ask for a closing cost credit that's given to the buyer? So in turn, they can give that to the agent. So as of, what was this, yesterday that was announced? Is that right?
Yesterday it came out, and Fannie and Freddie Mac just announced that they have the same policy, and that policy is that the seller concessions for commissions are not part of that amount. So it can be higher than the normal average 3 to 6% amount. Again, It depends on the transaction and all the details around it all, but that's really good news, healthy news for sellers to know that they can still contribute if they want to attract more offers on their property. And hopefully it means that they're all getting higher prices and everyone's happy at the end. So.
Yeah, definitely true. Steve-O, thank you for joining. And yeah, anyone who has a question, this is a live stream at 3:30 p.m. on Tuesday. If you're not watching it during this time, this is a pre-recorded video for you. Yeah. In any case, for anyone who's watching today's video right now, though, this is a live stream. And Steve, gosh, I really appreciate your support. Let's see here. Yeah, no housing crash yet losing patience. Yeah. I know. I mean, I
Might
feel,
be a while. Might be a
I
while.
know. I mean, I've been making these videos about the housing market for, gosh, what, 4 years now, and I just feel for the people who have not purchased a house yet, waiting for home prices to decrease big time, and we have this giant housing affordability issue. I really take on that stress because I know a lot of people want to buy a house, but they're seeing all the news coming out. Today we have rates at 7.5%. That's if you're putting 25% down and you have a great credit score. So some challenges for home buyers, to say the least. Were you going to say something?
Absolutely. And the thing too, I guess, as a renter is paying rent goes nowhere. If you're paying a large rent payment or a large mortgage payment, I'd rather pay a high mortgage payment and build equity. That's again, it's hard right now. I know it's not easy for a lot of people, and I think that study was about 3 to 5 million units short across the country on a yearly basis right now, just to get us to an equilibrium of supply and demand. And until that really takes place, it's going to be very difficult to be able to see a softening of home values.
Yeah, you need to see have like an overabundance of supply in order to see a substantial decrease in prices, right? And so we're not seeing that just yet. Steve, but we're just talking about this as well because we're doing an event tomorrow talking about the NAR settlement and how to provide value to clients and professionals. And yeah, my picture's on this flyer. It's a photo of me from like 10 years ago. So I need to update my photos. Just like I know a lot of real estate agents need to do that same thing. But yeah, I always tell people it's my younger brother who's 10
I think we
years
should
younger
do
than me.
a survey question on like the best avatar image of you. You know, they do like those like kind of AI photos.
Oh man,
We
yeah.
should get
My
like
wife
10 of
did
those.
that. It was pretty funny.
Yeah, we should get a couple of those and see what we look like.
My wife did that. It was pretty funny, actually. It was like a AI auto-generated like professional photos. So it was pretty funny. Yeah.
Cool.
Question: could you please give us your thoughts on? Yeah, I'm not familiar with any area really in Arizona at all. I do make like Arizona videos, but that's for the state as a whole. For any particular market in Arizona, I have absolutely no clue whatsoever. So if anyone can help out SG, then please leave a message there in a chat.
I'll be there Sunday through Wednesday in Scottsdale
Oh, there you go.
for a Housing Wire event. But yeah, I don't know where that is, but I will definitely see if I can help.
Yeah. And my photo was taken like 10 years ago, I think. I don't know. I need no photos. I know. I have no idea. Brianna says, hey, how are you doing? Thanks for joining in. Thanks, Steve. I'm glad you guys in here. It's just fine. Glad you like the background. Thank you so much. When is the bubble going to burst? Oh man. So yeah, it kind of goes back to the economics 101, talking about the balance between supply and demand. You need to see a huge increase in supply in order to see a huge decrease in demand, and therefore a decrease in prices. But real estate is local, right? We're in Santa Cruz, your area. You probably have a lack of houses for sale, I would imagine, and that's supporting prices. But areas like Austin, Texas, where's the other metro? In San Antonio, Texas, they have more houses for sale right now compared to 5 years ago, before the COVID happened, before the pandemic. So real estate is local, and hard to say, what will happen in the future here.
I was in Nashville, Tennessee about 2 weeks ago for another work event, and it was crazy to see how much growth was going in Nashville, Tennessee. I had no idea, but Nashville is kind of the Austin meets San Francisco meets New Orleans. It's got that kind of cool vibe, but it's a lot of growth. And can the jobs stay up with the cost of living? It's a struggle a lot of places across the country, as we all know.
Yeah, I'd say like especially the local community there, right? So you have a lot of people who moved during the pandemic. They're earning like wages that is not as far higher compared to the local wages. If they get called back into the office, then could present some challenges there. Christina, good to see you. Christina has, gosh, how many subscribers do you have now, Christina? 250,000, something like that. Amazing. Yeah, thank you very much, Christina. Appreciate that. I used to do a live stream with Christina a few times. It's been a while since we've done that. But thank you for joining us, Christina. Minnesota, it's always cool to see the people who watch our videos here and where they're located. I know they're all over the world, about 94% in the US, but all over the US as well. And thank you for your donation.
Wow, we should go out and have a drink tonight.
Yeah. Wow. That's pretty
Wow,
awesome.
cool, sweet.
$1.99. Yeah. I'm sure you know some place. Cindy, thank you. I'm glad the audio sounds good. All these people have been screaming housing crash for 4 years, not going to happen. So yeah, maybe we can kind of talk about the increase in rates. And if you're looking to buy a house right now, what can you do in order to make your payment more enticing? And how does this rise in rates really impact you as a home buyer?
Sure.
Anything you want to talk about?
Yeah, we right now, a big strategy the last couple of years has been what's called a seller buy down. What that means is getting the seller to give a credit to the buyer to buy their interest rate down for either a 3-year period, a 2-year period, or a 1-year period. What it is, it's a cascade waterfall down or up rate difference. So if my rate was 7% on a 30-year fixed, a 2-1 buy down would give me a 5% fixed on the first year, followed by a 6% fixed, followed by the 7% fixed. What that does is creates short-term relief. We're still qualifying the buyer on that 7% rate, but it gives them some relief while they're transitioning into the property to determine what they need. Maybe they need to buy some furniture, buy some short-term things. And also too, if rates were to go lower, they can refinance out of a seller 2-1 or 3-1, 3-2-1 or 2-1 buy down by getting that difference in savings. And what it does is the interest savings actually lumps the principal balance down faster, which is nice too. So a 2-1 buy down or a 3-2-1 buy down or a 1-year buy down are seller credits that fit in that Fannie Mae, Freddie Mac guideline we mentioned earlier to allow people to have more savings to feel better about their initial payment. But we are qualifying them at the fully indexed payment. So they're not going to have crazy payment shock later. They already know that they're qualified.
Yeah, I mean, I think that's good in some ways and bad in other ways. But I think the qualification or qualifying the buyer based on that rate they're going to get at year 3 for a 3-1 or 2-1 buy down is good. I mean, like if that was back in like what 2005, you probably would qualify you based on your initial payment. Probably you were
it was a bad thing. Back then the worst guidelines I ever saw were in 2004. Mm-hmm. People at a 1% start rate. They were qualified at a 1% start rate, principal and interest payment, versus the fully indexed payment, which is the margin and the index, which should have been like 4 to 4.5%.
Wow.
So a lot of lenders were putting people in these harm's way and these loans that they had no chance of really succeeding in. Fortunate to say I didn't do any of those, but some lenders that did them are no longer in business.
Yeah, I can imagine.
There was a comment about rent versus negative amp. Sorry.
Yeah, sorry, Christine. Yeah, typical realtor. I've updated my photos and my thumbnails in a long time.
We should get flip phones like back in the day, the Motorola flip phones.
I still have mine. My wife thinks I threw that away, but I have it.
The burner.
If my wife is watching right now, I still have my phone.
The burner phone.
Yeah, and my Nokia that was like this tall. It was like so cool to have like a phone that was like as big as your earlobe. Sorry, you saw a question where?
It's something about rent versus negative amp. It's a little higher up the list.
Okay, yeah. Let's see here.
There it is. John Doe.
John Doe. And we have 175 people watching. Like, we appreciate you guys so much. All right. John Doe says, when the rent is less than a mortgage alone, is that called negative cap rate? Jim Black.
So this is normally, when you hear the word cap rates, you normally think of commercial products. You think of a cap rate of certain percentages above all expenses. So unfortunately, that's not considering all the expenses. That cap rate question you have normally counts for the mortgage, property taxes, and insurance normally. Those are normally what's considered all those things that go into a negative cap rate. So if the rent is lower than all 3 of those categories, yes, it is negative. If rent is negative, you want to be the renter. If rent is positive,
sure. Not the landlord.
You want to be the landlord. So that's a simple way of looking at it.
Yeah, good call. Like what kind of thoughts? Yeah. All right, let me see if you have any other questions here. Sounds good. You drop the address to Scottsdale event. I'll see you there. I don't think it's a public event. SG is asking it. Could you drop the address of the Scottsdale event? I don't see it
Yeah,
here.
we will do a recap of that event. It's
Yeah.
a private event, and it's a lot of the leaders that you would find on social media in the space of real estate and lending. So pretty exciting.
That's cool. Yeah, Jim's a part of a number of different groups and provides, and you have a lot of, you know, firsthand connections with a lot of industry leaders, which is really cool.
Very lucky.
Yeah. And Lon, John, hey, Jason, John here from Sacramento. Awesome. Yeah, Jim and I live in Sacramento, obviously, and Jim grew up in Sacramento as well. Maldito Renesito. Thanks, Jason, for all your information on the market. Just as frustrated as everyone else. I hear you, buddy. I think our buyers are frustrated, agents, anyone in the real estate industry is frustrated because we have a lack of transactions. And on the buy side, home buyers looking at, rising rates and prices, and they're not seeing much relief in the way because rates are still increasing today. So challenging market to say the least for everyone. Long Island is brutal. Yeah, I'm not familiar with that marketplace. If you guys have any questions, just put question at the top there. Go ahead. You see one? Here's one. Question from Hank Duncan. Have you ever analyzed inflation-adjusted equity losses during other recessions? I believe there were periods in the 70s and 80s where inflation was way higher than appreciation growth. That's absolutely correct.
That's known as stagflation. Stagflation is when prices of things go higher and there's no real value perceived that it comes out of it. Milk and gasoline were that back in those time frames.
Yeah.
And that was a really sad position for everyone.
Yeah. I mean, I think
no one won in that regard.
Yeah, totally. I mean, I think I just made a video, the average rate back in 1981 for a 30-year fixed, 18%. It's like totally insane. Obviously, home prices were a lot less than they are now, but I mean, that's just crazy. Look at how high the rates were back in the 80s. David, Utah.
Utah.
Just Utah. Yeah.
Come to Utah.
Maybe you're in Utah.
Yep. They're, let's see what else we got here. A lot of people from across the country. This is awesome.
Isn't it so cool? Yeah.
I love this.
Louisiana. Luann Kelly from Northwest Minnesota. Hardly any new construction up here. Yeah, the areas that I feel that are kind of like mostly impacted regarding the rise in rates and inventory are the areas in which there's still a lot of land in which home builders are still building houses as well, because a lot of figures I share in my videos is looking at existing houses. So it's excluding all these houses being built. So areas in which there's still land to be built, unlike Santa Cruz and much of SoCal, the land is already built out. But other areas like in Austin, Texas, much of Texas, there's still a lot of building going on there.
And you know how long it takes, for example, in California, it takes between 12 and 18 months to get your permits to build a house.
Yeah.
And on average for new home builders, it's about $60,000 per unit that's built for everything from hookups to utilities to the permit process. So builders don't have a lot of motivation to build affordable housing because if it's a fixed $60,000 per unit, I'm not too excited about building a $200,000 condo. I'm probably more excited about building a $1.2 million home. It's a really unfortunate situation that we're in with the fact that builders are not incented. They're actually decented to do more units because the local jurisdictions look at that as more revenue that they can have for maybe important things like schools and security and firefighters. But again, there needs to be balance there. And unfortunately, a lot of this falls on the state level, not federal level.
Yeah.
Federal government really can't mandate things at the state. All they can maybe do is give subsidies for builders to do the right thing and build more and be more worried about helping families versus their bottom line pocketbook sometimes.
Yeah, I mean, I think that the best way to make housing more affordable, in my opinion, is to have more supply. So having more houses for sale. So therefore we need more home builders to build houses, especially in the more affordable range. But as Jim is pointing out, spot on, our local builders association in my neck of the woods, which again is in Sacramento, they actually just announced, or not just announced, but they mentioned in the report from about a couple of days ago that the average home builder in our area pays around $100,000.
Okay, wow.
Yeah. It's, I mean, yeah. to actually get a permit being approved, all the back end stuff. So $100,000, they're not going to be building and selling a $200,000 home, for example. They'd be losing a lot of money. So they're actually more incentivized to build these more expensive houses for sure. And it just continues to be a problem. Christina says, you're welcome on my live stream anytime. Thanks, Christina. She has a live stream. If you guys are interested, great YouTube channel. What is it? 1 o'clock Pacific Standard Time on Sundays, every Sunday. All right. Well, speaking of incentives, Cindy has this question. With interest rates rising, do you think new home builders will give more incentives to buyers?
So good question, Cindy, and thanks for your questions last week on our show too.
Totally.
You asked great questions. My concern, again, goes back to fundamentals. If there's a lack of supply of housing, they don't have to do as much as they should if there's more competition. So what I do think you'll see, if there is starting to be a turn in the market, builders like to do a lot of small releases of units so that they can continue to raise each phase in equity position to make more money and have more appreciation. If you see builders doing a blowout phase of half their project in one release, there's a red flag for you. So right now, unfortunately, I think you're going to see a lot of builders continue to do the small phases of projects, do just-in-time building, where they probably already have someone locked into a contract for maybe a 12-month contract, and they're probably only going to build the need right now. Again, with the cost being so high, they don't need to take the risk, unfortunately. I'd love them to build more homes, but they're probably going to be more economical about the way they build. So I don't think we're going to see a lot of crazy incentives. I will tell you, though, that last year, one incentive that was used in California by the builders a lot was the Cal HFA Dream for All program. It was a first-time homebuyer program, and a lot of builders use that systematically to get a better offer for their buyers. And unfortunately, it did a really nice favor for those new communities, but it didn't help a lot of the affordable older communities that need the extra support. So until there's something national or something more systematic at the state level that helps create more incentive for builders to build and give back more, I don't think we're going to see a whole lot of change, unfortunately.
Yeah, I would say that it's my opinion. It's real estate's local, and so some areas you might see like an overabundance of building, in which builders are kind of stumbling on themselves to build houses, and in a rising interest rate environment like we have right now, in general that decreases demand, and so therefore you might see some builders offering more incentives because it's becoming more costly to be a home buyer. And therefore they're seeing a decrease in sales. So in my opinion, an increase of rates, if these higher rates sustain for a longer period of time, then we could see more incentives being offered from home builders. But just today as well, the U.S. Census Bureau announced that the number of housing starts actually decreased. So we're not seeing builders ramping up production and buying houses. We're not going to see this giant surplus of houses for sale. We do have high inventory levels, but builders are cognizant of these rising rates and are not ramping up a production of building new houses, at least on a not statewide, at the national level right now.
And what's also interesting, we should look at some data around this. I think a lot of people are buying properties in newer communities because people that have been around and live in their property for a long time have probably either a lower mortgage or they have a lower interest rate. So they're most likely not super motivated to move right now.
Yeah, right.
Because it's going to cost them 2x to move. Their property tax may be portable to the next property, maybe not.
Yeah.
But we know that their cost of living is probably going higher. And unfortunately, it's just creating this kind of great stall out of lack of volume and velocity in our marketplace.
Yeah, right.
Again, it's just unfortunate. I'm most likely not going to move for the next 10 or 15 years. I'm lucky to have a rate in the 2% range, but there needs to be a really compelling reason for me to make a move, like a lifestyle event.
Yeah, exactly. Right. Definitely true. And Crystal, long-time subscriber. Hey, Jim, we can buy a beer each.
Sweet.
We'll do a cheers to Crystal
Yeah.
Later on today.
Thank you so much, Crystal.
Thank
Very
you, Crystal.
kind. Very kind.
Really appreciate you. Thank you so much.
Wow.
That's really kind of you. All right, let's see if there's any other questions. Again, if you guys have any questions, thanks, Crystal. If you guys have any questions, just put question in caps. I got that one from Christina. It was smart. Any comments on the Bay Area housing market? So one thing I'll add, I actually just looked it up before we started this live stream. The California Association of Realtors should have announced, March's numbers today, but it looks like they did not. So I'll have an update for you guys regarding the California housing market once they release that data, and that'll be announced probably in the next couple of days here. So I'll let you know regarding that.
I'd be happy to share some perspective though in the housing market in
Do
the
it,
Bay
Jim.
Area.
Yes.
So where we live right now, Jason and I are in Santa Cruz. We should put a better backdrop up.
Yeah.
But what we're seeing right now is people aren't going to move until they've found their replacement property. So even people that are of retirement age or baby boomers, they're not likely to sell their main nest egg or main house until they found their replacement property. We're seeing a tremendous amount of bridge loans still, or buy before you sell programs, because a lot of people that are retirement age can't qualify to get a new payment on a new property before they sell their current property.
Because you have to use their,
Because they have to use their payments and their income.
Right.
So a big thing we're seeing in the Bay Area still is a lot of buy before you sell and bridge loan programs that create an all cash like transaction to close quickly. Those offers are being accepted, and they aren't even the highest offers because they're guaranteed to close. Right now, we're also seeing on the other side of things, people presenting contingent offers. Can you explain what contingent offers are, Jason?
Yeah, so contingent offers were offers that did not get accepted in 2020 through spring month of 2022. So a contingent offer basically means, that was a joke, by the way. It basically means that you own a house, you need the equity out of that house in order to buy a new property. So you're writing an offer to buy a new place saying it's contingent on me selling my current house. That's called a contingent offer. All other things being equal, that is not the most enticing terms for a home seller, because the seller and the seller's agent or the listing agent is going to look at that and say, gosh, well, is your house even listed for sale? Because you have to use the funds to sell your house to buy this house. So is your house for sale? Is it already under contract with a home buyer? Is it going to sell or close? Or is the sale going to be, I always say close escrow, but I know it's different in every state. Is the sale going to be finalized tomorrow? There's a lot of variances there, but basically a contingent offer means that, hey, you're writing an offer, but you're not going to be buying the house until you're able to sell your house you currently live in.
It's almost like a domino effect. You're counting all the dominoes falling correctly, not incorrectly.
Yeah.
And that's just
I'll just say one thing. It could be even worse. Like, speaking of domino effect, like that buyer could also accept an offer. The original buyer could also accept an offer on their house that's contingent on that buyer also selling their house.
I may have been in a couple
So
of those.
like, no. I'm talking about domino effect. Yeah. So like, if that the buyer who wants to buy the other house, if that buyer backs out, it just domino effects. It affects the whole, 3 transactions really.
Yeah. So we're seeing that there's a premium to get those types of loans, but there's also a higher probability of getting the property of your dreams or the next home that you're looking to move into.
Yeah, definitely true.
Housing market, Santa Cruz.
This one, yeah.
Yep.
I saw Santa Cruz. Jacob Zamora, the Santa Cruz housing market will always be insane. Increase in rates has minimal impact on home sales right now, just low inventory.
Yep, no, that's exactly what's going on. Unfortunately, you can't build more land, like we mentioned before, and it is a hard situation. A lot of Santa Cruz County is being rezoned right now, and when you hear rezoning, all that really means is the existing footprint right now is being used for one purpose. It's then being rezoned to have more units. So,
but if it's being rezoned and their house is already on those lots,
there could be houses on the property. It could be farmland rezoned for multifamily. It could be single family level homes repurposed and rezoned for like 4-story buildings.
Oh my God.
Rezoning means more density. It means less lot sizes and probably supplying more housing for the population. So that's what we'll see a lot of in a lot of counties. And a lot of these things come in California from the state level. The state gives counties money for their general plan or their budget for their expenses.
Yeah.
When the state says you better rezone and get more housing units, you got to do that. So that's what's happening.
I mean, I'm all for about creating more inventory and more houses, especially more affordable houses. But holy cow, I couldn't imagine like living and then having my neighbor tear down their house and building a 4-story building. I mean, I know that I don't think you can do that in Sacramento. So maybe it's gonna be like a county specific. All right. Hope's healthy help. What's your best advice to? Would your best advice be wait another year and still rent? So my advice always. Same advice I've been giving people for 11 years as being a realtor is buy when it's right for you. Don't have someone tell you now is a good time to buy, now is a good time to sell, or now is not a good time to buy or sell. Everyone's gonna have their own opinion, but I would say that my best advice for you guys, if you guys want to buy or sell a house, especially for home buyers, I know a lot of my viewers are would-be home buyers, is that only buy if you have long-term time horizons. In my opinion, 7 to 10 plus years in which you do not plan to sell a house. And on top of that, if you're going to be buying a house, have a comfortable payment, so you're not stretching it every single month, and also have a stable job and emergency fund. If all those things line up, you find your perfect house, I would say go ahead and buy. But I'm not taking a stance here, say do not buy. I'm also not taking a stance of you should buy right now. Anything you want to add to that?
Just comes down to your own personal objectives.
Yeah.
That's what I think of it as. What are your objectives? What are your goals?
Absolutely. All right. Laura Graves, and thank you everyone for your questions. We have 250 people watching us right now. I think if I was in a room right now and there's 250 people watching us, I think I'd be pretty scared. Yeah. That's me, the introvert. Jim's more of the extrovert though. Jim is super comfortable talking to a stadium of 30,000 people, right, Jim?
Possibly. This is not water. This is
that's vodka.
Tequila.
Yeah. All right. Definitely not drinking. All right. A question. What is your opinion of the effects of the NAR lawsuit coming into effect in July? I'll take a stab at this one initially. So first off, this is just a proposed settlement. Is not finalized, but it appears that it will be finalized. And it will take place potentially in mid-July. The three main things are release of liability for certain realtors, brokers, MLSs, local associations. But number two, as a home buyer, you're going to have to sign a buyer-broker agreement in which it's going to stipulate, hey, if I'm the buyer's agent, Jim's my buyer, I'm going to say, hey, here's my buyer-broker agreement. Here's the services I'm going to be offering you, and here's my fee in order to do that. And on that document, supposedly, I should say, we'll stipulate how will that fee be paid, right? Is that fee, it's going to be X percent potentially of the sales price, or maybe it'll be a fixed dollar amount. And it'll also see on there that, hey, this is what I imagine what this will say. On there, it'll say, hey, we'll ask the seller to pay for this, but the seller is not willing to pay for it, or they're willing to pay for a portion of that, then I might ask you to pay for the difference there. So it's really going to be on a case-by-case basis. So as a home buyer, I would really look into that because prior to looking at any houses, this is much different compared to decades now, is that prior to looking at any houses, you're going to have to sign this agreement. So you want to make sure you're going to be hiring someone who is capable, professional, and someone you know, like, and trust, ideally, because you're going to be asked to sign something that has some potential financial repercussions down the road. So that's number two. Number three is that as a real estate agent listing a house for sale, there's right now still a field on the multiple listing service, or the MLS, that stipulates how much the seller is willing to pay the buyer's agent. That field is going to be gone potentially in mid-July. But as a buyer's agent, I can call up the agent, say, okay, how much is the seller willing to pay for the commission? And also there's other ways too that the buyer's agent can be paid as well, in the form of asking the seller for a closing cost credit to the buyer. So that's my take overall.
My personal take on this, Laura, is that we could see a shift of how the commission is paid for. I still think it will happen. Like Jason mentions, we want to have representation on all parties' sides. You want to make sure you're protected and you know the insights and complexities of the property you're buying. I also think that it does not help lower the values. People have made some bad comments or misinformation about,
sure.
hey, your house, the values are going lower, yip-de-doo. I think it's going to do the opposite effect.
Yeah.
I think
there's no way the seller's going to reduce the price. Oh, I don't have to pay the buyer's agent, so I'm just going to reduce my price. Like, that doesn't make any sense whatsoever.
What I believe is going to happen is that a seller will have a perceived amount of money that they think their house is worth.
Yes.
And I believe there could be a markup relative to that value that the buyer has to pay on that service provided. So it's interesting. We'll see what happens. And each market, like Jason mentioned earlier, is different and unique. So what happens in Santa Cruz may be different than Austin, Texas, may be different than New York City. Who knows? Yeah,
it's going to be it's going to vary by the area for sure. And this is also just pure speculation because what ultimately transpires and what happens is anyone's guess, really. But we're kind of figuring out like potentially what could happen here. But yeah, thank you, Laura, for your question. This is a big topic and something that we're going to be speaking about tomorrow here in Santa Cruz. All right, Deepak, do you think builders might offer more incentives on you? I think we already answered this as well. So asking if builders are going to be offering more incentives. In my opinion, they potentially will.
If the market shifts.
Yeah,
if the market shifts, yes.
All right. And then we have Jared Mann, 2393. Question, if I put 25% down on a house, how much money expressed as a percentage of the mortgage amount is a seller allowed to contribute to my buy down? May overpay $50,000 for them to buy down. May pay over $50,000 for them to buy down your rate. I think that's what he's saying.
So
how much money percentage of mortgage?
The biggest thing to know is just the simple equation is either 3 years, 2 years, 1 year buy down, 1 buy down, or 1 year buy down. So it's going to depend on, I don't have a calculator in front of me, I'm sorry. It's going to depend on the loan size and how long you're going to keep the loan for. So another thing to think about here is you say you may overpay $50,000 for them to buy down your rate. So yes, you have to look at the costs versus the savings difference. It has to make sense in a net tangible benefit perspective. A lender will not allow a buyer to have a negative ramification happen to them. So for example, it probably would cost $20,000 to save $25,000 of interest. That would be a doable thing that gives a buyer a betterment versus something worse. If it costs you $20,000 to save $10,000, it's not going to be doable. It's not worth your money. You're better off taking that into a different credit or getting a lower purchase price.
Yeah. To his question too, is a seller allowed to contribute to your buy down? And yes, they are.
Yes.
Yeah. So that's the seller concessions we've been talking about. You can ask the seller to pay for X dollar amount toward your closing costs, and you can use those closing costs to buy down your rate, and also to pay for your out-of-pocket expenses as well. So you absolutely can, but if you are in a competitive market, so for example, you have 10 offers on this house, one buyer's offering $500,000, you're also offering $500,000, but you're asking for a $10,000 closing cost credit. It's going to net the seller $10,000 less. So it can be used in select markets and depends on the house as well. All right, what else do we have here? Question from SG. What APR will have all the people jump back into the housing market and sellers seeing multiple offers?
So sellers, I believe, are already seeing multiple offers because of the shortages of the inventory.
Yeah. Varies by their location, yeah.
Yep. And like we mentioned last week's show, every 1% difference in interest rate reduction is about 5 million more potential buyers each 1% decrease. So be aware that as we see a decrease happen, you're going to see more people come off the fence.
Yeah.
I like the strategy right now, if you're looking for the long run purchase, to be buying when no one else is buying or when less people are buying. Because if rates do go lower, then you've owned a house, with less competition, and you can refinance potentially at a better rate.
Yeah, maybe
So
we can
that's-
talk about that because that's kind of like the point of the video, which we kind of like got sidetracked a little bit too. This is cool, by the way, doing this in person, side by side. Much more fun than like being in my like ugly like back
Because
studio.
you're going to start coming down every week. Perfect.
Yeah. So I'll be here every week.
Your
yeah.
wife won't mind at all.
Yeah,
I'm
yeah.
sure.
As long as I can stay for a couple weeks, then I'll come every week.
Yeah.
So what were we talking about again?
We're talking about the rates going lower.
So let's talk about that. So in an environment in which rates are increasing, that I think a lot of buyers are, feeling the effects of housing affordability, inflation, high home prices, elevated rates. So as rates increase more, that's going to cause more buyers to wait on the sidelines. So if a house gets listed for sale, it's your dream house or house you really are interested in, one would assume there'd be less competition for the house. So I always kind of think about like the spring months of 2022. I mean, the market was absolutely insane. I'd never seen anything like that before. Exuberance, to say the least. So writing very aggressive offers, and the buyers that were getting offers accepted, and, waiving all their contingencies, and in some cases, not even getting any reports ahead of time. So writing an offer blind, having no idea how the inspections are going to go.
And they were giving up their first kid too. That was part of it.
Some of them were they said they would name their first kid after the seller. That was literally in the news. Yeah. So I compared that. Like, that's great if you get your offer accepted because you have a 3% rate, but holy cow, like, did you have to pay like way over the appraised amount? Like, there's a lot of issues with that. In contrast, our market now, I mean, everyone knows we have a decrease in home buying demand because we have a lack of housing affordability. The upside of that, though, is that there's less competition because there's less buyers out there. So I would say it's kind of like a double-edged sword per se. You could buy a house in 2020, 21, where the housing market was insane. You might find, 5 houses you fell in love with and you didn't buy any of them. So, or now you could find a house you love. You might have maybe 1 or 2 offers on that property, have a better chance on buying the house. And on top of that, having your contingencies in place. So you get your loan contingency and appraisal contingency, inspection contingency. So in case something goes wrong, you can back out and get your deposit back potentially. So pros and cons regarding the increase and decrease. And that's why I always say buy when it's right for you and try not to time the market because that's nearly impossible. Coors Light, speaking of beer, thanks for joining in, Coors Light. I know he or she is often joins us in our live streams here. Can a non-real estate professional find out the historical and current cash transactions from a particular market? That's a good question. So if you're looking at like this house, maybe it depends on the details you want to get. In my marketplace, like in Sacramento, anyone can go to the Sacramento Association of Realtors. They have a website. They look at the percentage of cash sales in Sacramento County. So overall, for a region or a state, maybe nationwide as well, you can get that data. But for how did the buyer purchase this house? Overall, that's not public information unless you go to like the county's website.
Sometimes you'll see
building or
yearly
whatever.
stats that come out from National Association of Realtors or other organizations that can show data in the past. Most likely not real time. So if you're thinking about what's happening right now, it's not real time. So unfortunately, if you're competing to buy a house against all cash, you might not know how heavily weighted that market is with saturated all cash buyers.
Yeah.
But again, remember, you're competing not only with other people that have cash, you're competing with institutions and people that have funds and REITs, real estate investment trusts, that have a lot of money. So sometimes you're competing against the casinos when you don't realize it. So be aware, like Jason mentioned earlier, if everyone's going left, go right. If everyone's holding off, it might be a good time because you may have more options in the house you want to buy. So it's all about your time horizon. And if you keep that mindset, you'll buy when the right time is for you.
Yeah, I agree. I remember we were both in the industry in 2012, 2013 in Sacramento. I mean, that was like kind of the bottom of our market and there were so many investors. And I was just thinking at the time, I remember this clearly. How does a first-time home buyer buy a house right now when there's like all these private equity firms and investors buying houses all cash. How is someone with a 3.5% down payment going to even buy a house? It was very, very challenging back then. So
Those
if
companies that bought all those properties, there were
Yeah.
some that bought tens of thousands of
tens
properties.
of thousands, yep,
Did they sell them? No, they
Yeah,
kept them. They kept
exactly.
them as rentals because they knew the affordability index would continue to go lower, which meant people would be renting more and that they could increase the rents higher and faster than the cost of being a home buyer.
No, true. Yeah, and then on top of that too, like, well, yeah, I'll leave it at that. I lost my train of thought. Let's see what else we have here. I'm trying to find all the questions.
Thank you for all the questions, by the
Yeah,
way.
thank you everyone. We have 244 people watching. Really appreciate all of you. All right, let me see here. Kevin, awesome. Kevin's been a long time subscriber of the channel, so I appreciate you, Kevin. Thank you for joining. Any thoughts on the Atlanta housing market? I'll let Jim take this one.
Oh, yeah.
Sorry, Romeo. Yeah, I'm not too sure about the Atlanta market.
I don't know enough about it. I'm sorry, Romeo. I don't know enough about it. I'm sure Jason can connect you with someone local to talk more about it.
Yeah.
I don't know. I don't know Georgia very well. I don't know Atlanta very well. One of my other partners is actually in Savannah, Georgia right now,
Oh, cool.
speaking at a Mortgage Bankers Association conference,
Oh,
ironically.
nice.
Yeah.
MBA.
MBA, yeah.
Awesome. So yeah, Romeo, I'm not sure about the housing market there. A good website I like, not as paid promotion, is Redfin. So looking at Redfin Status Center, and you might have some stats potentially from your local association. So again, in my market, Sacramento, they have not weekly, monthly updates regarding what's happening in my marketplace. So you just Google Atlanta Association of Realtors. You might see some stats from them as well. So yeah, sorry we couldn't help out too much more than that. From Ryan, question: should I rent my house in Santa Fe for a 10% management fee? That sounds hefty. I'm moving to North Carolina and would like to keep my 3.2% interest rate. Yeah, I would look at potentially what is going to be your net amount you're going to rent or get from your potentially renting your house, and compare that to your housing payment to see if you're going to be positive or negative on your ROI. And I'm not too familiar with management fees in Santa Fe, neither in New Mexico, but 10% sounds a little bit hefty to me. But what do you think?
It depends on the price point.
Yeah.
And
right.
also, yeah, it depends on the price. I would just say, yeah, Ryan, you got to look at the opportunity cost and your money and see what's better for you. And that's just put it all on a piece of paper. And then also the headache element, which may be
Yeah.
a lot or a little of your time. Just because you have a property manager does not necessarily mean the headaches go away. So
True. Definitely true. All right. Mango Diet. Question: are squatting laws applicable to train stations, supermarkets, and museums?
great question. We're in California, obviously, Mango Diet. One thing I see every day when I go home is I see on overpasses, underpasses, and those turn off turnpikes.
Yeah.
I see people living there, and it's very frustrating. But it's because that land is zoned by the federal government, not by the state government or the local government. So a lot of times the jurisdictions are different in each city, county, state, and federally to be aware of. So can't really answer the question for you, but it is pretty sad when you see people that are in a worse situation than us or taking advantage of a situation. The hope is that they can get help, and the hope is that this goes away sooner than later.
Yeah, well said. Cindy has a question again. Any red flags I should look for before I sign a buyer broker agreement? And I would just kind of go to the dollar amount they're asking for. So the buyer's agent, again, is going to ask for X dollar amount or X percent in order to represent you as the home buyer. So in my opinion, that dollar amount, unless you're buying like a $50,000 house, for example, shouldn't be higher than 3%, in my opinion. So I would look for that number. How much are they asking for? And then if the seller is not willing to pay that amount, will you be on the hook for the difference there? That's my opinion.
Yeah, and again, Cindy, it depends where you live. Each state has a different take on this. My thing would be also to talk about duration of the contract.
Yeah, that's true. Yeah.
So
definitely.
how long are you working with this person? Is it 6 months, 2 years, perpetuity? I don't know.
Yeah, right.
And also, have you done your homework with any other references that they have Do they have good reviews on their Google homepage? Are they reputable in the community? Have they been doing this for a long time? Those are all things that you want to ask. Make sure you look into before you sign that agreement. And luckily, there is nothing to sign yet. So
Yeah.
if you're thinking about signing one, you don't have to right now. So that will come in July. But again, good to do your homework and due diligence.
Yeah, it's absolutely true. There's nothing's changed yet. Just a proposal, and we'll have to see what happens there. All right, let me just go through some more comments here, and we're going to go through until 4:30, Jim. Is that right?
Yeah.
So we have 10 more minutes, so we'll try to get through your guys' questions. We still have 255 people watching.
Thank you guys
That's
so much.
awesome.
Yeah.
I appreciate you guys so much.
Very cool.
Anthony Lopez, question: what are the pros and cons when purchasing a tenant in common?
I can talk about those.
Yeah, I'm glad. This is the beauty of having someone else, because I would have no value to give you whatever.
So Anthony, tenants in common is also known as tick, not as if you have a tick on your neck, but maybe a tick is basically in areas where maybe an old Victorian home that was 3 stories has been turned into 3 independently owned properties that have a percentage of the overall property in them. So for example, let's say there were 3 units or flats that were all equally owned. That would mean everyone has a 33.3% tenants in common, with the main common space being part of that. Those homes are very hard to finance. As a lender, it's really difficult because those loans are a blanket loan on the entire property, which means anytime one of those 2 other tenants in that 3-tenant example decides to sell or wants to refinance, you're all doing that with him or her. So be aware that a tenant in common type of transaction only really makes sense, in my opinion, when you can get out of that and the property is going to be getting its condo certification or townhome certification. TICs to me are a temporary way of having ownership to hopefully get out of that into your own ownership. So my dad taught me this really well when I bought cars early on in my life. Buy a very simple, plain car. Because it's not about you buying it, but it's about when you go to sell the vehicle, you want to have the biggest audience of people that can help be able to buy that vehicle. So think of a TIC really as a double-edged sword, like Jason mentioned earlier. Just because you can get into something, it may be a lot harder to get out of it. And again, you'll never have permanent financing, because if there is turnover in those units, you're going to have to refinance, maybe to a worse or better interest rate. So that could affect you personally. You're also betting that nothing negative happens to your other people that you're sharing that loan with. And unfortunately in life, things happen. So I would be careful, and I would own a TIC probably with my family only, knowing that, if they decide to do something, I may be able to take over part of that.
Got it. Yeah, makes sense. All right. Hank Duncan, question: are price cuts, available inventory or houses for sale, and days in the market still increasing week on week at a national level? I'm not sure about, so let's kind of talk about this. So days in the market, that is very much a lagging indication of our US housing market, or any market per se, because that's based on a closed home sale. So that's really what the market was like 1 or 2 months ago. So what I'm really focused on for the next couple of months at least here is the rate of changes of inventory levels. So if inventory starts skyrocketing, of course, that's going to be a sign of a weakening housing market. If housing inventory kind of goes like this and goes down once we surpass the summer months, that's going to be a sign of a stronger housing market. So in my opinion, I'm going to be looking at inventory levels and then price cuts as well. If we've seen that, home sellers, in order to get an offer accepted, have to do price reductions, that's also a sign as well. We saw that in 2022. The share of price drops, more than doubled in less than 6 months. So that's what I'm going to be focusing on. So price cuts and inventory levels. But I'm not sure. I think inventory is increasing. Is it still increasing? Yeah, inventory is increasing, and that's been going on for a couple months now. And then price cuts have also been increasing, but not very much. This is based on data from Altos. Research.com, Mike Sorensen. So yeah, overall, we're not seeing giant increases as of yet, but stay tuned. All right, let's see here. Question: as rates stay higher for longer, how does that affect the golden handcuffed effect?
It makes people stay in longer, I believe. The golden handcuff effect, in my definition, is the cost of living. Do you want to move? What's the upside and downside of moving away from a 3% interest rate when today's rates are close to 7.5%? If you don't need financing, probably not as big of a deal if you need financing. Well, a lot of move up buyers are in that boat. So to me, the golden handcuff effect is really affecting the middle class move up markets. And it's a really tough situation that we're in right now. So I'm with you on that, Chris One Pro, or Chris Gone Pro, excuse me. I'm with you. It's an effect, unfortunately, that will probably be here until rates, I would say, are within about 2% of the average rate, which is closer to 4.5%.
Yeah.
So that's where the average rate is. So once we get below 6%, I think we start seeing inventory free up. We started to see the effects of that in the beginning of this year, but then that cooled off really quickly as rates skyrocketed.
Yeah, and I think that we're not seeing like people like being forced to sell their houses, so we're not seeing giant increases of unemployment. If we start seeing that, like more layoffs, like Tesla announced that 10% of their workforce got laid off last week. So if we start seeing more layoffs and people forced to sell their houses, then of course that will impact inventory levels as well, regardless if they have a 3% or a 2.5% rate. Ricardo, it's going to be bonkers. Absolutely. Travis likes to say that.
It's going bonkers.
It's going bonkers. Sorry, it's going bonkers. Johnny Fly, good to see you, Johnny. And met Johnny, several back in January, I think it was. I hear now is the best time in history to buy a house. Is that true? Johnny's always trolling that. I love it, man. Appreciate you, Johnny. Yeah, you're always funny. Nick, question. I keep seeing listings with assumable loans. Seems enticing to take over a lower interest rate loan. What are the pros and cons? Jim.
Okay. So assumable loans normally are portfolio loans, old FHA loans, and old VA loans. While I say old, it's because they're normally seasoned by this time for about 10 to 12 years. So if a loan has been if a loan's that old, first of all, the loan limits back in the day are probably about a third or a fourth of what they are today. So for example, if that original loan balance was $300,000, today it's probably $200,000 on the remaining principal balance. When you assume a loan, you assume the remaining principal balance. So if that home that was bought 10 years ago was $300,000, now it's worth $1 million.
Yeah.
And the assumable loan is $200,000. That means $1 million minus $200,000 is the down payment that you have to bring in.
Yeah. So how many people with the FHA loan have $750,000 when you're using a loan program with a 3.5% down?
Exactly right. Yeah. So unfortunately, a lot of times that is not really a good equation for anyone to be part of, because you're going to bring in more cash, more capital, and equity really doesn't do anything for you unless you're buying or selling something. Equity is dead. Having equity in your property doesn't mean anything at all. You can't leverage that to potentially make more money or have other investments. So that much of a down payment, in my eyes, would be a red flag just to get a rate of 3% or 4%.
Yeah, I think there's certain scenarios in which that could work out though too, right? Because like an FHA loan, someone buying at the peak of the market in 2022, and maybe their home value is down or slightly up, then it could make sense. You could be your difference in that, what they owe versus how much they're offering could be, minimal. So there could be scenarios in which you could assume a loan at 3% rate, for example, but those are probably a few and far between, I would imagine. 429. Let's kind of wrap this up. I know we have some questions here real quick. Hank, is there data on if people are more leveraged in the past few years versus historical norms? I personally was approved for way more than I feel I can afford.
All comes down to your preference. Just because you can doesn't mean you should. And we have guidelines that we follow, but that does not mean we should always push those limits. It's about the ability to repay, but it's more importantly about the ability to be comfortable and live comfortable within your means. When we look at housing payments, we don't look at all the other factors like how big your cell phone bill is. Do you have Comcast? Do you like to barbecue and have steaks every night for dinner? We don't know all those things about your lifestyle, but we just know that if you're not comfortable, then you shouldn't do it.
All right, question from Kerr Plode. Isn't the seller not saving money after the lawsuit? We're talking about the NAR lawsuit. The savings go straight to the buyer's agent when it's time for them to buy. I don't think so. It's more or less the same as before.
I don't believe this is fundamentally a correct answer or question, I should say. Thank you, Kerplode. The challenge here is that this is for the sellers getting back something of misrepresentation for them. More importantly, it's setting the bar. It's starting fresh for everybody to have a better way of disclosing fees and get rid of any collusion perspectives that existed before. Collusion being around the fact that realtors could see how much they were being paid and maybe be steered towards one house showing versus the other. Now those fields of how much they're going to be paid on the buy side are being taken out of that equation. So that way they're going to have to represent the best interest of their client at all times. And that will be not known. What will be known is that they have a buyer broker agreement for their compensation amount.
Definitely, I think it'll just basically add like an additional level of transparency, which is needed. But I think there's some negative effects regarding this as well. Question: I am in the opinion of holding off on a home purchase until at least there is one rate cut instead of buying now with a hope. What's your take on the current market? So my take on the market is that, buy when it's right for you. I mean, I know people are sick of me probably saying that, but if you're going to wait for rates to decrease, when rates decrease, you're just going to see more competition. Just kind of plain and simple, right? If you have a 7.5% rate right now, if rates were to decrease to 5.5%, you're going to get a lot of home buyers off the sidelines looking to buy a house, and that's going to push home prices up further. So I would say that if you find a house you love, you're comfortable with the payment in the long term, then go for it. But I worry about the people who are waiting for rates to decrease, and then they see that competition increases big time, and then home prices just start skyrocketing once again.
Could you show by any chance the Fed funds rate change? We have time. We'll do it next time.
Maybe we can do that next time. Yeah. I don't know if we have any other questions too. It looks like we might have no more questions here. So I guess we'll kind of wrap it up on that note. By the way, too, let us know what do you guys think about this time. We decided to do this at 3:30 instead of 4 o'clock. And we want to make this, live stream for you guys each and every week, because it's challenging for me to answer all your questions on my channel, because otherwise, if I did answer all your questions, it'd be a full-time job. So I want to do this for you guys because I can bring on Jim, someone who I know, like, and trust for 35 plus years. You've been a loan officer for 20 plus years. I've been an agent for 11 years. And so I think that Jim provides some perspective and some value to you guys. And I want to do these live streams, or we want to do these live streams to provide value to you guys to answer your questions. And
we'll start putting tidbits on my channel also of fun facts, fun mortgage facts. So if you have specific mortgage questions, you can reach out to us. Again, we are a team. We're here to help, and know before you owe. Make sure you make good decisions. You have great facts. Jason's been providing. You have now 1,082 videos?
Yeah, 1,082.
Is it really?
I think you're right. I think yesterday was the video I posted today was like my 1,082nd video.
I have it marked on my arm. I just keep marking like notches on my body.
Cross it off. Yeah. All right. Well, thanks, Cindy. Thanks for joining, and thanks, Steve. Appreciate you, and thank you. I appreciate you very much too. Potential tax. All right. Well, great. We'll wrap it up today with the hop off. But thank you everyone for joining us in today's video. We appreciate you. And this is so much fun doing this in person. I mean, we should do this more often.
Heck yeah.
I see you get the free pass from my wife to go to Santa Cruz. Anyways, thank you everyone for joining us. Please like and subscribe, and we'll see you on the next video.